Welcome to VeriScope News. Our objective is to provide verified news and clear context. We prioritize data over narrative and structure over hype. This report examines the structural relationship between labor earnings and the cost of essential goods and services. We focus on the factors that influence purchasing power in the current global economy. The relationship between what a worker earns and what those earnings can buy is a fundamental metric of economic health. In recent years, data from many developed economies has shown a divergence. While nominal wages, the actual dollar amount on a paycheck, have often increased, the real wage, the value of those dollars when adjusted for inflation, has faced different pressures. This phenomenon is often referred to as a cost of living squeeze. Understanding this requires looking beyond a single number. It requires an analysis of housing, energy, food, and debt. It also requires an understanding of how productivity and corporate structures influence the distribution of capital. When the cost of essentials rises faster than the rate of pay increases, households experience a decline in discretionary income. This has long-term implications for savings, retirement, and overall economic stability. Currently, several factors are converging to impact global purchasing power. Since 2021, many nations have reported the highest inflation rates in 4 decades. Central banks have responded by raising interest rates to cool the economy. While these measures aim to lower inflation, they also increase the cost of borrowing. For many, this means that even if a salary increase is secured, the additional funds are immediately absorbed by higher mortgage payments or credit card interest. In the United States, Bureau of Labor Statistics data has shown periods where the Consumer Price Index, or CPI, outpaced average hourly earnings. This means that in terms of purchasing power, many workers were effectively earning less than they did the previous year, despite having a higher nominal salary. Similar trends have been observed in the United Kingdom, the European Union, and Canada. The sectors most affected include housing and services, which tend to be less elastic than consumer electronics or apparel. To understand why paychecks feel smaller, we must look at the historical trajectory of wages and productivity. For several decades following World War II, wage growth and productivity growth moved in tandem. As workers became more efficient, their pay generally increased at a similar rate. However, beginning in the late 1970s, a gap began to emerge. Productivity continued to rise due to technological advancements and automation, but real wages for the average worker began to stagnate. This trend created a situation where the benefits of economic growth were increasingly directed toward capital owners and high-level executives rather than the broader workforce. Additionally, the shift from a manufacturing-based economy to a services-based economy changed the nature of labor bargaining. The decline of union density in several Western nations also played a role in how wage increases are negotiated. Furthermore, the globalization of supply chains allowed for cheaper consumer goods for a time, which masked the stagnation of wages. Now, as supply chains become more complex and localized, those price cushions are disappearing. The impact of the wage-price gap is most visible in household finances. For the average household, the 3 largest expenses are typically housing, transportation, and food. Housing costs have seen significant appreciation in value over the last decade. In many urban centers, the growth in home prices and rents has significantly exceeded the growth in median household income. This forces a higher percentage of income toward fixed costs. Regarding prices and bills, the volatility of energy markets has a cascading effect. When the cost of fuel rises, the cost of transporting food and consumer goods also rises. These costs are usually passed on to the consumer. For the individual, this results in higher utility bills and higher prices at the grocery store. In the labor market, the relationship between jobs and wages is in a state of transition. While unemployment rates have remained low in many regions, underemployment remains a factor. This occurs when individuals are working in roles that do not fully utilize their skills or offer enough hours. Additionally, the gig economy has introduced a segment of the workforce with fluctuating incomes and fewer benefits, complicating the traditional understanding of a steady paycheck. Savings and debt levels are also being affected. When the cost of living rises, households may reduce their savings rate to maintain their standard of living. In some cases, consumers turn to credit to bridge the gap between their income and their expenses. This leads to higher levels of household debt, which becomes more expensive to service as interest rates rise. For businesses, higher labor costs can squeeze profit margins, leading some to automate tasks or reduce headcount to maintain stability. This creates a feedback loop where the drive for corporate efficiency can limit the very wage growth that consumers need to sustain the economy. Economists and policy analysts are monitoring several key indicators to determine the future trajectory of purchasing power. The first is the trajectory of core inflation, which excludes volatile food and energy prices. If core inflation remains high, central banks may keep interest rates elevated for a longer period. Another factor is labor productivity data. If technological integration, such as artificial intelligence, leads to a significant spike in productivity, experts are watching to see if those gains will be shared with workers in the form of higher wages or if they will primarily benefit shareholders. We are also seeing a focus on real disposable income figures. This metric accounts for taxes and transfers, providing a clearer picture of what households actually have available to spend. Additionally, the quit rate, the frequency with which workers leave their jobs for new opportunities, is seen as a sign of labor's bargaining power. A high quit rate often suggests that workers feel confident they can find higher paying roles elsewhere. Finally, experts are observing the global housing market. As high interest rates persist, the volume of home sales has slowed, but prices in many regions have remained resilient due to low inventory. Any significant shift in housing affordability would have a major impact on the overall cost of living. For the viewer, these economic trends suggest a period of transition. The era of low interest rates and low inflation that characterized the 2010s appears to have concluded. This requires a shift in how individuals think about financial planning. When wages do not keep pace with inflation, the primary focus often shifts towards efficiency and the prioritization of essential expenses. It is also important to consider the role of skills and education in a changing economy. Data consistently shows that workers in high-demand, specialized sectors tend to see wage growth that better tracks or exceeds inflation. Understanding which sectors are growing and which are contracting can be a factor in career decisions. While the data can seem complex, the core issue is the balance between supply and demand, both for goods and for labor. As the global economy adjusts to new geopolitical realities and technological shifts, the relationship between work and reward will continue to evolve. Monitoring these structural changes provides a clearer perspective than reacting to short-term market fluctuations. To provide further depth, we can look at the specific way economic data is collected. The Consumer Price Index is calculated by tracking a basket of goods that represents average consumer spending. However, no individual spending perfectly matches the average. A person who commutes a long distance is more affected by gasoline prices than someone who works from home. Similarly, a renter is more vulnerable to housing inflation than someone with a fixed-rate mortgage. This variance explains why some people feel the squeeze more acutely than others, even if they earn the same salary. Economists also distinguish between transitory inflation, which is caused by temporary supply shocks, and structural inflation, which is embedded in the economy through wage price spirals or long-term shifts in demographics. Understanding these distinctions helps in assessing whether current economic pressures are likely to be short-lived or a more permanent feature of the financial landscape. By looking at the data through these lenses, we gain a more comprehensive view of the challenges and transitions within the modern global economy. Thank you for watching VeriScope News. Our goal is to provide you with the facts and context necessary to understand the forces shaping our world. We remain committed to neutral, data-driven reporting. For more verified news and clear context, please ensure you are subscribed to the channel. We will continue to monitor these economic developments as they unfold.